Hey guys, Hermie here. There's two things I want to address before I start today's video. The first one being that I know a lot of you were sent over here by the Humble Trader, so thank you very much for choosing to subscribe to my channel and navigating this super fun journey through finance with me. And Shay, thank you so much for giving me that super unexpected shout out. I was totally not expecting that. It really does help me boost my ratings on YouTube, so thank you. If you guys don't know, Shay just uploaded a very funny parody video for April Fools. I made a cameo appearance in it, so I'm basically famous now and you can't talk to me anymore. I'm just kidding. The second thing I wanted to address today is hate comments. So in the last video, I got my first hate comment. Unfortunately, I couldn't reply to this individual anymore because they might have deleted the comment already. What I wanted to say about hate comments is that with everything that's happening around the world, there's so much hate just going around for no apparent reason. Just be nice to each other. I'm not hurt or anything. I have such thick skin. I used to work in customer service in my previous job, and I worked in the kitchen for just under a decade. Nothing phases me anymore. I've seen many things and I've had worse things hurled at me. If you're watching this and you're thinking about starting a channel, don't listen to these people. There's always going to be someone who's going to say something negative about your appearance or something that you're talking about. If you're passionate about what you're doing, you will find your audience and good people will find you one way or another. Alright, let's get started with today's video. Welcome back to another episode of Money Talk with Hermie. I am your show host, Herman, but everyone here calls me Hermie. On today's topic, we're going to be talking about bonds.
Oh, yeah.
No, not bondage. Bonds. Bonds are a type of debt. So essentially what you're doing when you are buying bonds is that you're lending money to a corporation or a government, and in return, they'll pay you interest for you lending them your money. There is a set expiration date for bonds. So we kind of categorize bonds into three types. There are short-term bonds, which the time period is less than 5 years. There is a medium or intermediate term bonds, which are between 5 years to 10, and then there are long-term bonds, which is 10 plus years. At the end of that period, which we'll call maturity date, the issuer, such as the corporation or the government, has to return the face value back to you. For instance, if you've purchased a $5,000 5-year term bond, at the end of that 5-year term, the issuer will return you your $5,000. So why should you buy bonds? When you buy bonds, the issuer will pay you an interest rate. Now this interest rate could either be a fixed rate or a floating rate, sometimes called a fluctuating rate. For instance, if you buy a 5-year bond, the issuer may pay you 4% fixed rate, which means they will only pay you 4%. Whereas if you buy a bond with a floating rate, it might be tied to the market or it might be tied to the interest rate. As the rate goes up or down, then the issuer would pay you accordingly. Similar to how a mortgage works. There are fixed rate mortgages and then there are variable rate mortgages. Depending on what type of bond you buy, it can generally be considered as safe, which means it helps pare down risk in your overall portfolio. And when interest rates tank, like in our low interest rate environment right now, you can actually sell your bonds for a lot higher than what you initially paid for. Broadly speaking, there are 4 types of risks that you need to keep in mind before you purchase any bonds. The first one being interest rate risk. Generally speaking, when interest rates go down, bond prices go up, and vice versa. When interest rates go up, bond prices come down. These two are like the yin and yang of each other. Like everything in the market, timing is everything. But never time the market, Warren Buffett said so himself. There might be a chance that you may need to sell your bond at a lower price than you initially purchased it. In a low interest rate environment right now, bond prices are very expensive. If you have purchased bond prices right now when they are very expensive and suddenly interest rates go up, if at that particular time you need to sell your bonds for whatever reason, then it's very likely that you would have lost some money on that. The second of these risks being inflation risk. In layman's terms, inflation basically means your dollar today is worth less than what it was before. If your bond was yielding 3% and in that particular year, inflation was pegged at 3%, then your real returns would be negative 1%. So you lost 1% overall. And if your bonds so happen to mature in that particular year as well, using the previous example, if you have purchased $5,000 worth of bonds, then when the issuer returns you that $5,000, it would be worth much less than it did when you initially purchased it. Thirdly, there is something called market risk. This basically means that the entire bond market tanks for whatever reason. So it doesn't matter if it's a high quality bond or a low quality bond, everything goes down. And lastly, credit risk. All entities out there are usually given a credit rating, similar to how we get credit scores. It basically means how financially stable you are. When we're strictly talking about credit risks and the financial stability of the issuer, such as the corporation or the government, it's their ability to repay the money that you initially lent them. So if a credit rating agency like Standard & Poor's, for instance, gave company A a AAA credit rating, it means that it is very likely that they will be able to return the money back to you along with paying you with interest. If a credit agency gave company B, for instance, a low credit rating such as B-, then they have a higher chance of defaulting and being unable to return the initial money you lent them, plus they may not be able to make any interest payments to you. In one of my previous videos, there was a viewer who asked me a question about bonds. Kelvin, this is for you. I hope I was able to answer some questions for you. So like anything we do with money, there's always a risk involved with it. You might have heard high risk, high rewards. It's the same thing with this, except when it comes to bonds, it's low risk, low returns. What that means is, as I kind of piggyback off of what I said earlier about credit ratings and credit risks, if you have a AAA credit rating, meaning that you are super low risk and that your cash flow is good and you're financially very stable, generally speaking, the payout is a lot lower than it is, say, for a company who has a lower credit rating. There could be a variety of reasons for this, but for the most part, it also depends on the term of the bond as well. Undoubtedly, you will come across something called a high yield bond. These are bonds issued by corporations or governments with a lower credit rating. A high yield bond pays you a higher interest rate, whereas a low yield bond might be issued by a company or a government with a higher credit rating. Now, how is it that we compare short-term bonds versus long-term bonds? Short-term bonds generally have a lower risk, but lower return as well. Whereas a long-term bond would have a higher risk, but a higher yield. The reason why long-term bonds have a higher risk, it's because of a variety of factors, such as market risks, interest rate risks, as well as inflation risks. We don't know when the interest rate's gonna go up, or when can we predict inflation, or when we can predict a market downturn. Hence why the longer you hold on to a bond, the higher chances you may experience one of these things. What are some things you can do to mitigate risk when buying bonds? I work as an advisor during the day. I basically act as a gatekeeper and a risk manager, protecting my clients' portfolios from themselves. One of these strategies is to use laddering. What we do here is buy bonds that mature at various different times. For instance, I could buy a short-term bond, some mid-term bonds, and then some long-term bonds to mitigate the risk of interest rate fluctuations. A second strategy is just to diversify, such as mixing different bond types, lower yield, higher yield, government, corporate. Or you might be just looking at me right now, scratching your head like, okay, all right, that's a lot of things I need to think about just to buy bonds. It's hard enough to buy stocks, so now I gotta think about all these things when I buy bonds? The easiest thing to do is just buy a bond fund. There are so many products out there, ETFs, mutual funds, segregated funds, just buy a bond fund. It's instant diversification, you don't need to think about it. All this talk between stocks and bonds, how do they compare to each other? Over a long period of time, now I stress this,
long period of time,
stocks will outperform bonds. Just take a look at this chart I found on the internet. The S&P index has more up peaks than there are down peaks compared to bonds. So does that mean that bonds no longer have a position in your portfolio? Of course not. When I structure a client's portfolio for them, there's a variety of things I need to find out. I might have touched base a lot of these in my previous video. I'm not some star manager here. There are some people out there who say bonds are a done deal and it's like super old school way of investing. And then there are other people out there who are saying like, no, there's always a position and there's always a place to buy bonds in your portfolio. I kind of like to just mix in the middle. I think it's always better just to take the best of both worlds. So that's it, guys. That concludes my video on bonds.
Bondage?
No, bonds. As always, if you've found value in this video, please go down there and hit that like button. And while you're down there, just right next to it is the subscribe button and the little dingy ding ding. Please click on it and help me support my channel grow and help bring more people into this channel so they too can learn more about finances. If you have any questions, please leave me a little comment down below, or like what the previous viewer did, if you have a suggestion or idea and you'd like me to talk about it, please go ahead and leave that down there below. I always love talking about new topics and various asset classes. It helps me grow as an advisor as well, and it keeps the channel going. I'll see you guys next time on Money Talk with Hermie. Bye bye! Such as mixing different bond types. Lower yield, higher yield, government, higher yield, lower yield. Did I say that already?